capital asset pricing model. And you may recall that in the last lecture, I had explained what is the capital asset pricing model. Today we will continue with the discussion, but and we will take up the calculation of the beta, that is the measure of market risk, and other implications like how can we use CAPM for finding out a security uh, which is underpriced or overpriced. And in the last part of my lecture, I will also show to you the calculation of beta using Excel, taking a real life example. And similarly, we will also go on to discuss further about the various asset pricing models as well, like arbitrage pricing theory and others. So the important point which I discussed in my last lecture, the the discussion started with the idea that the Markowitz, the efficient frontier, when it is combined with the risk-free rate, it becomes the linear line when we combine. There was no change in the calculation of portfolio return, that is the weight, the amount of money invested in risk-free and the rest in the risky asset when you combine it. Then we went on to discuss the calculation of the portfolio risk. And the portfolio risk, we try to understand that once we incorporate a risk-free asset, then the curve becomes linear in nature. And this is known as the capital market line. And the general version of it, security market line. Capital market line tells us about the relationship between risk and return. And it tells us that there is a linear relationship between risk and return, higher the risk and more the. And this is relevant for efficient portfolios. Means the efficient portfolio means that the portfolios are already diversified. So therefore, two types of risk which are there. One is called market risk, and the other is called the company specific risk. Company specific risk. So this is also known as systematic risk, and this is known as unsystematic risk. So in a efficient portfolio, this is specific risk. If you have 15, 20 stock or you diversified, this risk can be diversified. It means that this risk will be zero. Almost, not zero exactly, it will be negligible. Let me put it, modify my statement. But this risk, which is market risk, are caused by macroeconomic factors or other factor, will continue to be there no matter how diversified. So what the CAPM or the capital market line, which is a general version of this, says that market will reward you for bearing a risk which is undiversifiable, cannot eliminate this risk. No matter how, whether you buy thousands of stocks in your portfolio or 10,000, all the universe of stocks, this risk will not. And you may recall that this was the graph which we have drawn, that there are two types. This risk is diversifiable. As you increase the number of stocks, this risk will be eliminated. But this risk will stay on, which is nothing but the market risk. And this risk arises because of the microeconomic conditions and other, like change in GDP, inflation, interest rate, exchange rate movement, and global event, and so on. So this risk cannot, this is going to affect all the securities, all the assets, irrespective of the level of diversification. So that is why The capital asset pricing model states that the risk which will be priced in the market will be undiversifiable, systematic, or market risk, not this risk. If a stock, for example, has got high level of company specific risk, and then it will not be priced. So because the reason is that diversification can reduce this. Why should market price a portfolio which is under diversified? So that is why uh, the risk which matters relevant in the world of CAPM is market risk. And this model, SML, that is security market line, relates beta and return. Beta is a measure of systematic risk in the market, that is a market. And it is nothing but the slope of the regression of the market return with the individual return. And market is very important in the world of CAPM. Market is proxied by some index, maybe Nifty, maybe it's already diversified, and this is considered to be efficient. That is why this line which is touching here is some index. So this is considered to be, in terms of risk, it's already diversified. So what risk remains is market risk. So enough dive. 30 stocks are there in the Sensex. So it's already, the moment you move beyond 30, so it becomes a large sample. So that is why 50, 100, 500, and like that. So that is why if you run a correlation of these indexes, you will find that they are highly correlated, means movement. So it means that they may convey the same thing. So some index, and that is why market, which is represented by some index. In real life, the calculation of computation of market index, which will comprise of all the assets in the economy, not financial assets, real estate, and all that, is not possible and has been constructed by some people. But this, so it has no special, importance, because this portfolio denote and what the portfolio of proxies like index they convey, they are almost identically. So there is no benefit, having such a large. But ideally, it should be like that, a market portfolio which is efficient. Now, with this brief background, why I repeated this thing, because, just to bring home that now CAPM described that expected return on any security I is made of two components. One is called risk-free, that is without, if you do not take any risk, plus the amount of market risk, which is the beta, amount of risk, and this is the risk premium. And is it return on market, let us say index, Nifty, minus treasury bill or some other risk-free. So this is the risk premium. So if we know that risk-free is information is available, return on market one can calculate on Nifty, beta one has to calculate it. So higher the beta, more the risk. That is why this is a linear relationship. If any given other thing, if any security has got high beta, so it should fetch higher return because it has got more market risk. So because investors have to be given a premium for holding a security which is risky, they have to be compensated for that. Now we will use this further. For example, I have taken an example of this in the last part of my lecture. For example, this information was given to you, beta was calculated, and how we'll calculate, we'll take up in a moment from now. 1.5. If any beta greater than 1 means that it is the risk is more than the market. Less than 1, it means that, and equal to 1 moves same like market. This is called aggressive securities, higher risk. This is called defensive securities. They move with the market, but less. They are less riskier than the market. And here, this is same like market. This is the less one. So it's a defensive security. It has lower risk than the market. So that is why, given other thing, for example, 1.4 this D will have the highest return because it's a other thing are given. The market return is given 6% return on market. So risk premium is 12 minus 6. That is the difference between RM minus RF. So we just plug these values here. You can get it to this. So higher the beta, this is the, you see that 0.71, 1 is the by default in the market. If any security has got 1, it means that it should get a return equal to the market. So it is the no risk security, it is the risk of the market, and this is the premium. Premium means over and above this risk-free rate, if you are. So the security which has got high beta should fetch high return. So the implication is very simple. Higher the beta, more the return. Higher beta means market risk. So this way we can arrive at, I'll come back to this point, negative beta stock, slightly later. Now, how we calculate beta, you can see this equation. Now, here on the left-hand side, this is the regression equation, is the dependent variable, okay? Whenever we write on anything on the left-hand side, dependent. This is return on market is independent variable. And this is the intercept, and this is unexplained variation. Regression, if you have done in the first year, you must be knowing that when we are doing this thing, then there is a intercept, like if you draw, a line. So this part is called alpha, and the return on market and return on security, if you run a regression, so it will be like this. So this slope is nothing but the beta of the market, which is calculated as covariance security I with M, that is the market, let us say Nifty, and divided by the variance of the market, that is the variance of the Nifty. And this is the unexplained. This cannot be. So our immediate concern is to know about this. Have also got an implication, but for the moment we want to know that how much a security moves with the market, and that is why what we do, that we run a regression. We run a regression using as a return on security, any security, as a dependent variable, and return on market as dependent variable. And when we get this beta, which is slope of the regression line, it tells us that how much is the amount of risk in that security. So let us see that how it is calculated. So this is like, we arrive at. So this is an example. Let me make it full screen. Now you see that this is the return on a security A. You can name it anyone. And return on market, just assume for the moment, it is Nifty 50. And this is say XY is the company. Okay. So we have calculated the return on this. And how we calculate this thing, like in take the market, return calculation simply is we have calculated the return. It may be monthly, or you can assume that yearly, monthly return. Let us say 15 observations are there. So return on this is calculated, and you know how we calculate the return these things. So we have calculated it. Now please remember that we are setting, I'm telling you the manually, the how we do this thing. So we have to find out the slope, that is for the beta. So what we have done here is we have to find out first the covariance in denominator, covariance of security A with the market. Okay. And for covariance, and then we have to find out the variance of the market M, that is let us say Nifty, and this will give us the slope beta. Actually, this is how we calculate in regression also. So, and in order to calculate a covariance, we calculate the mean of the market and return of the market. So, and we have subtracted from this. Same thing we have done it in the covariance calculation. So 10 minus 10 is 0, and so on. Similarly, for market, it is 9. So we have 12 minus 3 is 9, and so on. We have done it. And then we have taken the product for covariance. This 1, 2, 3, 3, 4. So it is nothing but 3 into 4. Okay, we have done it, product, added it, okay, 221. And then we have to find out the variance for the denominator. So what we have done is that this is available already here. So we have squared it, okay. So when we square it, then it becomes 9, 25, and then added 624. Now let us go further. So covariance is nothing but the security A with M. 15 hour observations are there. So we divide it by this, we get 15.97. This is for the numerator. And variance of market, if we get it 26 divided by the number of observation, we get 44.57. Now same thing we have done here. We have divided this 15.79 with 45.57. So the beta comes out to be 3.4, which is less than 1. It means that the stock is a defensive stock. It moves less with the market. Defensive stock, so it's a 3.4. So this is how we calculate it. You should understand, the way. So this is how it is carried out, and like that. I will also tell you in Excel. In Excel, there is a simple function of what we call it. Let me for the moment stop it and show to you. Okay. You see that these are the returns which have been calculated here for the TCS and Nifty. For 2000, these figures were calculated last year for just class purpose, so I am just retaining it. And Nifty, we have calculated it, the return. And how can we, from any site like NSE and other thing we can do it. So what I have done that, there is a function in Excel which we call slow function, or we can use it through the we can use it through the this data analysis function, which is shown here. For instance, if you want to calculate beta, so there you just click here slope. Slope is the regression. It is coming regression through the data given point. Okay. It's a known wise. So this is so just to show the entire this up to here. Comma. Just you can also type it here or just drag it up to. And close the bracket. You get a beta of 0.916. Okay. So it means that this is the same way which we arrived at, the beta is less than 1. So we are getting it at, you see, which is less than 1. So in this way, we can calculate it. So it is less than 1. So it is defensive stock of like this. Same way, there is also a function in Excel which can be used, which is data analysis, which gives the entire, alpha, beta, and all these things. So like, data, there is a data analysis here. And there is a regression. Just click it here, regression, scroll down. Now it is same thing. It is showing input y range means dependent variable. So you can just drag it or just type the last first and last two. It will. So 55, A55, okay. Now we click on the dependent variable. So you can up to B55. It's asking you where you want to place your output. So let me put it at E E 60. Okay. So now click OK. Other options are also there. This is the input which has come. Okay. Same thing we have received it. X variable is the beta. Okay. So X variable is nothing but the beta which we have got through the same simple function. This is the alpha value, and this is all the significant values, T statistics and all that. So this is R square also. So if you want to use it, so in this way we can calculate it. And I had told you that the beta of market will by default will be 1. For instance, covariance of market with the market. We have taken covariance of security, let us say TCS and in Nifty. We have taken it, okay? I mean, this is beta of, we have calculated it. This is dependent variable, this is independent variable. If you are asked to find out when beta of Nifty with Nifty, so it will be by default will be 1. Let us verify this. And I had already explained to you. For example, slope function, if you here just put it here. Slope, I'm not going to that elaborate one. So just okay. So this is the up to 55. This is the first one. Okay. And it is asking followed by comma, then the other variable, that is the dependent, because the same one, but just for verification we are doing it. Okay. Now we close the bracket and hit enter. There is some mistake, I think. Let me check it. What is the issue with that? I think that the B3, it is A3. Let me change it from here. A3 to A55, no problem. I will type it just. A3 to A55, comma, same B3 to B55, hit enter. I think mistake is there actually. I'm sorry, I make a mistake because you know that again I am using the same one, dependent and dependent. Now I will have to change it with B because both variables are same. Actually, there was mistake. This was the mistake. Same thing. B3 and same B55 because with the market. Now hit enter. It is 1. Actually, a mistake was there. I was, here showing the earlier one, but now we are taking Nifty with Nifty. Okay, that is why. So by default, the beta of Nifty will be 1. So that is why it is showing here. Here, the slope of this B, which is given in B. So that is why it will by default, because the movement of market with itself is nothing but the The one or the you have studied also in the covariance matrix that the variance of any security is the covariance of any security which is set in nothing but the variance, so it will be one. So in this way, we can understand we can calculate the beta of any security using Excel as well. And this is very simple. Slope function is there in regression as in the Excel, and elaborate regression output can be had by running data analysis. In some cases, it may not be available. So go on to add in, and you can have this data analysis also. Now, when I have opened this thing, let me show to you some other thing. You see that in the last lecture, I had tried to calculate the efficient frontier. The same thing I have done is for capital market 9 also. So return I have calculated here, weightages I have given, and like this, like the efficient frontier. So, and then I went on to use the same thing, the what if function, by varying the weightages. So I have just depicted here the return of the security using a scatter diagram. So same thing which I had calculated there, I have also done it in my sheet. And so, I mean, just as a depiction on it using Excel like this. For instance, if I change the weight here, so let us say, assume that, just mark here, that the maximum the return is here, the 25 and 14. So, sorry, 20 and 14, it is not 25. So 20, and this is, I have changed it actually for that matter. So now if I change it something, weight, if I change it here, let us say that more than 100, 1.2. Let us see what change comes. You see that this line has become extended further up to here. Mean that you can get more return of that, but you know that we have to pay rate of interest on this. For example, if you are investing more here, then you will have to pay rate of your borrowed portfolio. So in this way, one can, by changing the thing, borrowed and lending portfolio, one can have it. So I'll provide this to you, and you can go through these things. So I'm closing this thing, and I'm coming back to the my discussions. Okay. Let me once again go back to this is how we calculate the beta. Now the next thing which I would like to discuss with you is how we calculate the portfolio betas. So how portfolios beta are calculated? The calculation is very simple. We calculate the individual betas as I've shown to you, and then what we do that, for example, there are 3 securities and n number of securities. We multiply by the amount invested. W1 is the amount invested. W2 is the amount invested in. If there are 5 securities and equally weighted, so we will make 0.2 multiplied by the beta of security 1, 0.2 multiplied by the C, and so on. So we'll add it, it will give the portfolio. So it is nothing but the multiplication of the portfolio beta, individual beta, with the amount invested. So in this way, we calculate. For example, this is the amount shown here. 3 stocks are there. 4 stocks are rather. Beta is this. In some cases, it may be total amount may be given. So what you have to do, you have to add this. Okay. So 2, 5, 9, 7, 9, 29. Okay. Now 15. Okay. 30. I think 30,000. Okay. Total we have to add it, and then for how much amount is spent, 2,000 divided by the total amount. Okay. that will give the weightage if it is the total. Same way for second 5,000 divided by a total amount. So weightages, if it is not given, in this way it can be worked out. It will be 1.2525, 1.25. So we have got the weightages. So in what we have to do is that we have to multiply by the weightages. Okay, the portfolio beta, and then if the portfolio beta is 1.38 of this, it is riskier than the market, the portfolio beta. So simply the multiplication 0.251, 0.2513, and so on. It is a weighted average. So now I'm discussing something different, from this. Now, by now, you must be familiar with the idea, and I think I have been repeating it again and again, that this is the expected return on a portfolio or security return. If you are not right, I, no problem. Beta of security I, that is the market risk. So beta of market will be by default. Now, this equation, expected return on any security I, as given by beta, is risk-free rate plus RM minus RF, that is risk premium, multiplied by the beta, that is the risk of a particular security. So this tells us that how much return we should get. Now, using this benchmark, now if it comes out that a security should provide a return which will lie on this line, because this is any deviation from this security market line will lead to either undervaluation or overvaluation. For example, if security is providing this much return, whereas according to CPM, its return should be this much. Okay. This line. Now, what will happen since it is providing more return? Then what will happen? That arbitrage process, that is, it is undervalued, which is providing higher return. So people will start buying it. When they're buying it, the return will come down to this level. I will explain it further. Just wait on. If any security is providing lower return than what is mandated by CFM, according to this, security B should provide at least this much return. That is providing lower return. So what way people will sell it? When they sell it, it's a price falls and it's a return mover. Now, in order to understand this thing, you should keep in mind the return formula. What is how we calculate the return? P1 minus this divided by this. This is the price prevailing now. This is the price when it was bought in the beginning of the period, and this is. What I'm saying is that if it is undervalued, people will try to buy it. They will push up the price. When they will push up the price, the return will come down. Return on a security is P1 minus this is change in price divided by the current prevailing price. So return will come down. When this becomes higher, this will come down. In other case, return security is this much. When people start selling it, because it's a lower return, so this price will go down. When the price go down, the return will go up. So it becomes, aligned with so that is why if any security is underpriced, a process sets in which we call arbitrage process. Two securities which have, similar risk return profile should not offer higher return. If it is having higher return, people will exploit that opportunity and will try to bring. In real life, what happens that this beta, there might be some band, For example, exactly it may not be like just lie on this line, because there are transaction costs also in buying and selling. So that is why some deviation may be there from the equilibrium, because you are undertaking there, you have to spend money, transaction costs, and therefore the might be, but you know that this provides, and this equation is very, very important. You know, this is CAPM, as I told you, has got immense application. For example, if you want to find out the cost of capital, how for to discounting factor, how much return you should expect on a security. If you want to know the performance of any mutual fund manager, we use this the method which are derived from CAPM. That is why CAPM is the most widely used. Same thing has been explained here. So that is why what we call the buying undervalued securities and selling undervalued securities. So it calls this is called arbitrage process. When you buying the a goods market, if anything is being sold at lower price, people will buy it, and anything which is sold at we will sell it. Same, any security is providing higher return, and then what is mandated by prescribed by art by the certain models like CAPM, people will buy it if, and then that will push up the price and return so that there is a convergence with the price. And if any security is providing lower return than what it should provide, then people will sell it so that they, so like this is called arbitrage process, the under and this drive down and the expected return, and they are becoming in line with the risk return profile. So CAPM has been, as I told you, that has got immense application in the various areas and like that. And the message of CAPM is very clear that there is a positive relationship between risk and return, and the risk which matters in the world of CAPM is market risk. Market risk is measured by beta. Beta is nothing but the sensitivity of stock return with it is nothing but the slope of the regression line. So that is why higher the beta, more the return. Give another thing. So the lower the beta, if any security has got beta greater than 1, it is riskier than the market. We should provide a compensation for bearing that risk. That is, and if it is lower, it is moving. So that is why high beta stock, they move with the market, more the market. So they're riskier. So in good time or bad time, in bad time, they may provide lower return. Good time, when market is moving up and risky, you move with it. So it does not provide, hedge as such, because, but the stocks which are, have got a beta lower than this, then it means that they are moving with the market, but their movement, so they may provide some protection against the market movement. So, and in some cases, we may find stock which are negatively, which is very rare. They are betas which are negative betas. So what are the implications of negative betas? Just let us go back and show to you. For example, in some cases, if a stock has got negative beta, if we just keep in mind this equation in view. So what CAPM is saying is that beta and return, higher the beta, more is the return. If anything has got negative beta. So if you put in this equation negative beta, the return on, let us say, return on the security is risk-free rate plus RM minus RF, that is return on market, and the beta of a security. If beta is negative, so this term, so it means that this term will become in the entire negative, and then you subtract from this, like this example. Suppose the stock of bank is this company, that I have calculated the beta for number of securities over the year. Hardly we find that because of some technical error or which are negatively correlated because of some technical issues, or in some cases it may be also. Assume theoretically that there is a possibility of having a negative beta. So because the expected market is higher than, so this is the beta of it is minus 0.3, and so risk-free rate is 4, and and return on market is 10. So this is 6%, and this is and then you multiply by this. So 4 minus this will be 2.2. It is lower than even the risk-free rate. Any risk-free rate is 4%, and it is offering a return of 2.2%. Now, what is the implication of this thing? The implication of this thing is this kind of, if you find this stock which has got needed, it can has act as an insurance, a hedge. Hedge is means that you can minimize the risk. For example, if anything is moving up, then this is counterbalanced by another strategy. Hedging. So it's a kind of insurance. If market is falling, then because it is negative, it moves against the market. Therefore, it can provide a protection to that. So that is why the investor can accept that even negative beta, because in bad times it will provide insurance again. And that there are some contra stocks, maybe they will move against the market. So we have also some contra funds as well. So they invest, not exactly by beta strategy, but the beta strategy can also be used in that way. So this is the implication of having a negative beta also, and that provides. So with this, I have covered CAPM because you know that CAPM is very vast topic, and my own PhD is on the CAPM. If you go to the one of my papers published in way back in 2000, in Vikalpa, this is Journal of Ahmedabad. So there is a title, CAPM should be stop using it. So because so almost 2000, so it's almost 22 years back. So it was based on my PhD thesis. So the CAPM, because that in CAPM is an elegant model, and which tries to relate the relationship with the risk and return, and it says that risk and return, they should move together, and that risk which is immaterial in the world of CAPM is market risk, because other risks can be diversified away. So CAPM has, as I said, that one of the most widely used concept in finance after NPV, and because present value method, and in present value also CAPM guides us that discounting factor. For example, a cash flow is to be discounted at 15%, 20%. CAPM provides the benchmark. That whether because if any project is risky or how risky it is, so the required return of cost of capital can be found out by using CAPM. But what happened that CAPM has come under severe attack because of some empirical finding which describe that the relationship between risk and return as measured by beta is not statistically significant, or the relationship is positive or significant, not as CAPM tells us. In some cases, the relationship was negative. The return and risk, they move in, but they were not significant. For example, in my study also in India, I found that the risk return relationship is negative, not positive risk return. But this was not significant. Therefore, the jury is still out. We cannot say that CAPM is dead. But over long run, CAPM has been found to be a descriptor, and there are anomalies also in the some returns which cannot describe by using certain risk-based model like momentum and other factors which are there, and other anomalies like small stocks have provided higher returns, small cap, than the large cap stock. Like value stocks have provided higher return. Value stock means high book value to market value stock, they have higher return. So all these anomalies are there, size effect and other, which tries to undermine the prediction of CAPM. But still CAPM survives, and it is one of the most. Other models have been developed like Pharma, French and other, and like that. And that is why in order to overcome these things, multi-factor model has been built. And one of the multi-factor model is the arbitrage pricing theory, which I am going to describe. And that arbitrage is considered to be one of the most important pillars in finance. any mispricing, anything, arbitrage process, law of one, it is also called law of one price. Two securities are there, like in goods market, if two goods are there, one is being sold at a cheaper price, higher price at one place or other place. So people will buy cheaper one and sell so that price becomes equalized. Same way in financial market, in terms of risk return, if any return is stock is providing higher return than the risk, so people will buy it, and then because of that, a equilibrating process will take place. So this model is a multi-factor model, which does not specify what is that risk. It says that the risk return of any security is determined by multiple factor, not one factor. And that is why the word arbitrage has come. And like any other model, CAPM, the arbitrage pricing theory has got some assumptions. And it was developed by Stephen Ross. You know that Stephen Ross has written one of the very popular book on corporate finance, Ross, Westerfield, and Jeffrey. I think you have not seen it because in most of Pandey, we do not look beyond Pandey and others. So most of these people, they have copied from. So although Pandey's book is good, I'm not saying that. So because two leading textbooks in finance, corporate finance are there. One is written by one is by Bareilly and Myers, and another is by Bareilly and Myers is the most popular book in corporate finance, and Ross Westerfield. So Stephen Ross was professor at MIT. He has come out with this model, which is similar to CAPM. So behind any model, there are assumptions. If those assumptions are not valid, model will not be valid. So same start capital market is characterized by perfect. There are a large number of the buyers and seller of securities. So no seller or buyer is strong enough to influence security price. All the investors have got the same expectation in terms of mean, variance, and covariance, homogeneous. Investors prefer more wealth to less wealth. This is a rational assumption. So there is no need to have any assumption regarding risk attitude, whether the investors are have average risk, neutral risk. If you prefer more wealth to less wealth, that will be implied from that. No rational investor will prefer less wealth to high wealth, to more wealth. A very large number of capital assets exist in the economy, and this can help us in creating a portfolio which can diversify away non-systematic. Again, I repeat, diversifiable risk. And there are enough securities. For example, any security, there are very few assets, and therefore the chance of risk diversification is not there. So that is not relevant here. If enough security assets are available, which offer that you can diversify away the unsystematic, specific, idiosyncratic risk. The only risk which will remain in that portfolio will be the beta or systematic risk factor, which we call factor sensitivity. So based on this thing, this model has been developed. An investor can construct a zero investment portfolio and in an efficient market, which I will explain after this in next class, because the foundation of all these models are based on which market, which we call efficient. Just for the moment, I will just tell you that market efficiency means that the security prices reflects all the information, past information about security, public information, publicly available, and even private information. The publicly available information, company-related information like dividend and so on and so forth. Similarly, past information, how the securities have performed. The market is considered, this is the bedrock of all the efficient model. If the market is not efficient, then so in this market, if there is arbitrage opportunities will not be there. For example, let us take will be wiped out. An example to understand why this. Let us say that if one can borrow unlimited amount at 5% in a in the market, very simple example, and let at 6%, that the potential profit will be, for example, if somebody borrows from bank, and deposit, borrow from A and deposit in bank B and get a rate of interest 106%, then it will pay back 5% to other, and then will make a profit of 1%. It is arbitrage profit. If there is some kind of opportunity like this, then this will be wiped out quickly. In securities market, the implication is that if any security, as I pointed out, that there are two securities, risk and return, let us say risk, this is the risk. Beta of those securities is 1.25, 1.25 same. This security is providing high return 15%, and this is providing 12%. So what will happen, that the risk is same of these two securities. And so people will start buying this security. And when they buy it, the return, when they buy it, P1 minus PO, this is the return. Just I'm writing just to remind you that this will be pushed up price, and then this return will be in line with the 12%, so that there is no divergence, Otherwise, it will become a money machine. So arbitrage opportunities will not be. So the major assumption behind this model is that in financial market, arbitrage opportunities will be wiped out by the savvy investor. And this model assumes that there is no need for large number investor. If there are 50, 60 financial analysts who are always on the lookout for underprice, overprice, are trying to, so these kind of opportunities will not be there. And nowadays, because of the algorithm trading, such opportunities do not last for very long. They are quickly detected and they are exploited, and so that is no longer profitable. Right. So what this model says, that the risk is risk and return relationship is driven by not one factor but several factors. For example, if we take that I, any factor is one single model, like here we have taken return on market there. So there is some common factor which affect all. Common factor, what may be common factor? Let us say inflation in the economy. This is the common factor. Industrial production. Let us say GDP, exchange rate, just an example. These are the common factors. So a single model may be where returns are, generated by a single factor. But Stephen Ross says that the return on a security is determined by multiple factors. So that is why I start from 1 to K, J to K, number of factors may be there. So like it is like a multiple regression you run it. Using these factors like inflation, interest rate differential, yield rate, and other things. So instead of running, simple regression, single variable regression, a multiple regression is run, and on that basis we can find out this. So, and that some studies have taken factor analysis. They started with a number of factors, then they have reduced it. The difference between factor analysis and multiple regression is that in factor analysis, we may have a very large number of factors, and finally we eliminate it, and after the elimination, we run the regression. And here, if there are some factors which we know it that from the theory, economic theory, like inflation affects all the interest rate changes affect all the securities in the economy. So those common factors can be used. And Stephen Ross has not provided what we call it, what are these factors, but he says that there might be multiple factors. So that risk premium of those factor 1 with the risk premium and so on. So it is like in a multi-factor model, only multi-factor model, not one beta, but several betas are there. Okay. like return on security is alpha plus beta of security, let us say inflation, first industrial rate, beta 2, and in the exchange rate, beta 3, and like this, like, so we run a regression on based the, so like, so he says, but he has not provided, the, what are these, some empirical studies have. The difference between this model and CAPM, in CAPM says that the risk of a security determined by market, and market is dependent by some index. Some people say that market, all these factors collapse into the index, because market, when index fluctuates, then it captures the effect of all these factors, which may result from inflation and other things, because it is said that stock market is, but not normally it may happen that this may reflect all the factors. So it is a multi-factor model, multi-factor model, and based on the idea of few assumptions. So it does not have very long distant number, and it has no role for market portfolio. Like we take that it is proxied by index, and so there is no need for this. Other common factor may be there, which may be so that relationship. And like this is study by Rawl and Ross himself, they were carried out. So they looked at industrial production, yield rate, default spreads, any high quality borrower and lower. And this is yield curve, the relationship between interest rate and the bond yield over short term and long run. So they said that they suggest that four factors may be there, but they have left it for empirical studies. What are these systematic factors, common influences that affect all the securities? And there is no consensus as such now, but we know that all the macroeconomic factors, some of these, they affect the securities. So that is why it gives room for having a model which is driven by not one factor, but that the one model, although not in this way, Farmer and French model, 1993, says that return on security is based on not only alpha, let us say, market, that is which I have already told you about beta index. It is said that SMB, small minus big stock return, plus the value stock, that is HML, high return provided by high book value stocks and low back value. And then further factors have been added like momentum, those stocks which have performed well. And then we have also model like liquidity adjusted models. So there is a lot of list of that factor. So these Stephen Ross says that they are macroeconomic factors that affect all the securities, irrespective of their diversification. And no matter how diversified you are, but the systematic risk, that is market risk, the undiversified risk, will affect all the securities in the market. But because these factors are not, left open, therefore arbitrage pricing theory has not found much application except like CAPM, which you easily can calculate return on market and you can easily get it. So with this, I have briefly covered the models like CAPM, which is the major model, and arbitrage, introduced to you the arbitrage. In my next class, I will go on to discuss about efficient market theory, which is provide the foundation. Market cannot function if the efficiency is not there. How the market processes information and how they react to that information. Whether market follows a random walk, how market reacts to dividend announcement, and how the mutual fund managers perform, whether they can beat the market. All these questions are important in the finance and the investment management. Now, if you have any question, you can ask before I close for the day.